Welcome to the Deep Dive. We're your guides for getting right to the heart of company earnings calls.
Yep, cutting through the jargon.
Exactly. And today, we're tackling Matador Resources Company, that's ticker MTDR. We're digging into their second quarter 2025 earnings call.
Right. We listened in, went through the details, and we're here to break down what really matters from that call.
Okay, so let's start with the big picture, the results snapshot. What was the overall vibe from management?
Well, the word they used was satisfied. But really, it sounded more than just satisfied. They seemed genuinely pleased. They called it a solid, well-executed quarter. Strong performance basically across the board.
Okay, solid and well executed. Let's put some numbers to that. What were the key highlights?
Well, first off, they actually boosted their full year 2026 guidance.
Oh, really? For what specifically?
For both oil production growth and cash flow. So, more oil and more money coming in, looking ahead to 26. That's pretty confident.
Definitely a strong signal. What about current production?
Huge jump there. Year-over-year production was up 31%.
31%. Wow. Okay. That's significant growth.
It really is. And it wasn't just the upstream side shining. Their midstream operations, San Mateo, actually hit record EBITDA for the quarter.
Record midstream profits. Okay. I heard something about cost there too.
Yeah, they actually lowered their midstream OPEX guidance. So making more money and spending less to do it on that side.
That sounds like a winning combo. What about the balance sheet? Debt levels?
Still looking really strong. They kept emphasizing that debt-to-EBITDA ratio is now below 1. So very healthy financially.
And shareholder returns. I know that's always a focus.
Definitely. They mentioned increasing the base dividend again. That's 6 times in just 4 years now.
6 times. Wow. Shows consistency.
Right. And they also kicked off a share buyback program for the first time. Bought back about 1% of their shares just in Q2.
Okay, so dividends and buybacks.
Yeah.
And operational efficiency. Anything stand out there?
Yeah, this one really caught my attention. Their DNC cost drilling and completion costs per foot came in well below their guidance.
Below guidance. So they're finding ways to drill cheaper than they expected.
Exactly. Driven by efficiency gains, they said. That's pretty impressive execution.
Okay, so that's the snapshot. Strong growth, midstream records, good financials, returning cash, and beating cost expectations. Let's dig a bit deeper now.
Right. Let's talk about the financials and their strategy first. That integrated model you mentioned earlier is key.
The upstream and midstream ownership.
Yeah, they kept bringing it up, calling it unique. They argued it's what lets them deliver strong free cash flow margins while also growing oil production. Not always easy to do both simultaneously.
Right. Sometimes you see companies sacrifice cash flow for growth or vice versa.
Exactly. They stressed balancing those two things, boosting production, but also boosting cash flow. And being smart about spending that cash, mostly on good drilling opportunities, while keeping that balance sheet solid. Especially, they noted, in turbulent times like these.
Makes sense. And they have the financial firepower to back that up.
Oh, yeah. They highlighted having $1.8 billion available on their credit line.
$1.8 billion. That's a lot of cushion.
Huge cushion. And strong bank support, they said. All 19 banks in their syndicate are still fully supportive, and most are in the midstream facility, too. So the banks are clearly comfortable.
Any other sort of financial tailwinds mentioned?
Yes, actually. They seemed quite optimistic about some cash tax savings coming from a recent tax act. Apparently, it's going to push out their AMT alternative minimum tax payments for several years.
So deferring tax payments.
Basically, yeah. Which should start benefiting their cash flow position as soon as Q3 this year. So more near-term cash flexibility.
Okay, interesting. Let's pivot to operations then. You mentioned those DNC cost savings. How are they achieving that?
It sounds like a combination of things. They talked about success across their drilling program. They're now producing from, get this, 20 different zones in the Delaware Basin.
20 zones, just in the Delaware.
Yep. They called it a land of opportunity. Lots of layers to target there. And they also briefly mentioned Louisiana. A deal with Chesapeake reserves some Cotton Valley formations for them.
Cotton Valley gas.
Yeah, maybe 200 BCF or more. But they're holding off on developing that, waiting for, better gas prices.
Smart. Okay, back to those DNC costs. You said down significantly.
Down 11% year over year compared to Q2 2024.
11%. That's a real drop.
It is. And they gave specifics on the drilling side. Those U-turn wells they drill.
Right, the ones with the curve.
Yeah. They're drilling those 10 days faster now, on average, compared to just 2023. So like a 2-mile well went from 25 days down to just 15 days.
15 days. That's shaving off a huge chunk of time.
Massive time savings. And then on the completion side, they're using something called a tri-frac process.
Tri-frac. How does that help?
Well, it saves about $350,000 per job compared to the more standard zipper operations. And it's faster, too, like 20 to 30% faster than Simfrac.
So faster drilling, faster completions, cheaper completion.
Pretty much. They summed it up by saying drilling and completing wells is overall maybe 10 to 15% faster now than just 6 months ago.
That pace of improvement is quite something. How is it just squeezing vendors on price?
They actually made a point of saying it's not just about beating down prices, it's more about strong, long-term relationships with their key vendors. The driller, pipe suppliers, fracking companies like Schlumberger and Halliburton.
So collaboration.
Yeah, continuous collaboration, working together to find ways to improve, iterate, tweak processes, less adversarial, more partnership-focused.
That makes sense, like that feedback loop you mentioned earlier.
Exactly. It's about optimizing together, not just haggling over the invoice. Plus, another point on efficiency water recycling.
Ah, yes. ESG and cost savings.
Right. They're recycling over half their produced water now, which generates, real savings on disposal and sourcing costs.
Okay, so the operational efficiency is clearly a big part of the story. Now, you mentioned the Midstream, San Mateo, setting records. Let's unpack that a bit more. They called it a game changer.
They did, because it gives them flow assurance, basically a guaranteed way to get their gas processed and oil transported, especially in New Mexico, where pipeline capacity can get tight.
Right. Avoids bottlenecks that other producers might face.
Precisely. And look at the growth. They went from 0 midstream capacity at their IPO to now having 720 million cubic feet per day.
720 million. That's huge capacity.
It is. And their newest plant, the Marlin plant, is about half full right now. They expect it to be near full by the end of this year.
So they're filling it up quickly. Was building that plant a tough decision over, say, drilling more wells?
Management addressed that directly. They said building that plant, which cost over $200 million, was a strategic choice. They saw it as balancing the business, adding a stable, fee-based midstream component to complement the more volatile upstream.
Longer-lived assets, more predictable cash flow stream.
Exactly. And crucially, that flow assurance we talked about. They directly linked San Mateo's record performance this quarter to their own record production growth. The two go hand in hand.
Synergy in action. Any other examples of that coordination?
Yeah, they mentioned saving about $1 million on chemical costs this quarter, just because the upstream and midstream teams worked closely together. Little optimizations like that add up.
Okay, but here's the interesting part for investors, right? The value proposition.
Right. Management was quite open about this. They believe the market isn't fully recognizing the value of San Mateo within Matador's current stock price.
So they think the midstream part is undervalued.
That's what they're saying. And because of that, they're patiently exploring strategic alternatives.
Which means what? Selling it, spinning it off.
Could be various things. They mentioned debt or equity options, even floated the idea of a potential IPO for San Mateo down the line. But they also stressed they don't need to do a deal.
Because they're free cash flow positive.
Exactly. Gives them leverage. They can wait for the right opportunity, the right valuation, rather than being forced into something. They also highlighted their third-party business's strong repeat customers, near 100% uptime.
So it's a solid standalone business already.
Seems like it. They even added a new connector line recently between their Black River and Marlin systems just for more operational flexibility.
Okay, interesting dynamics there with the midstream value. What about the outlook? Activity levels going forward. They mentioned rig counts.
Yeah, they'll be running 8 rigs by the end of this week. They did temporarily drop rigs back in April, remember?
Right, when things looked a bit more volatile.
Yeah, they called that a tactical move to optimize capital efficiency for 2025. Now they're ramping back up slightly.
Do they need to add more rigs soon to keep growing in 2026?
Interestingly, they think they can actually wait. They believe they can defer the decision on adding more rigs until later this year, maybe even early 2026, and still hit decent growth next year, relative to the industry average anyway.
So those efficiency gains are really paying off, letting them do more with less.
It seems so. They did signal higher capital spending in Q3, though. That's partly because they pulled some activity forward. So wells coming online late Q3 will really boost Q4 production.
Gotcha. So maybe a bit of lumpiness in production quarter to quarter?
Probably, especially with developing multiple zones in the Delaware. They do larger batches of wells for completion, which can cause those bumps, but it also means really strong initial production when those batches come online.
And are they finding it easier to get good rigs and crews right now?
They hinted at that. They mentioned opportunities to high-grade their equipment, get better rigs, better frac fleets in the current market, cherry-picking the best gear.
Another efficiency lever.
Okay.
So they're generating free cash flow. How are they thinking about using it after paying the dividend?
They laid out 3 clear priorities. Number 1, brick by brick land acquisitions.
Brick by brick, meaning?
Small, targeted deals. Continuously adding acreage to replenish their drilling inventory. They see this as a core strength, almost a competitive advantage, just constantly adding good rock.
Okay, reinvesting in the ground, priority 2.
The share repurchase program we mentioned, they have a $400 million authorization, and they used it in Q2. They said it's price sensitive, though. They'll use it when they see value, especially during market volatility.
Makes sense. And number 3?
Balance sheet, just continuing to pay down debt over time, driving that leverage ratio even lower.
So land, buybacks, debt reduction. And they think the brick by brick land strategy works well right now.
Yeah, they suggested it's particularly good in the current market, which seems less focused on huge company transforming M&A deals. They can pick up quality bolt-ons without maybe as much competition.
All right. So stepping back, what does Matador's story tell us about the broader energy sector right now? What's the relevance for you, the listener?
Well, I think it really highlights the potential power of that integrated model, combining upstream and midstream, especially in volatile markets. And their focus on disciplined capital allocation, balancing growth, cash flow, and returns is kind of a blueprint for how E&Ps might aim for more sustainable performance.
Less boom and bust, more steady execution.
That seems to be the goal. It's about navigating the cycles.
So if you're following Matador or the sector, what specific signals should you be watching?
Definitely watch the midstream side. How quickly does that Marlin plant fill up? Any news on those strategic alternatives to unlock value? That's huge.
Right, the potential spin-off for sale.
Yeah. Also, keep an eye on rig count decisions later this year or early next. How does that track with their 2026 growth ambitions compared to peers?
And those efficiency gains, can they keep it up?
Crucial question. Watch those D&C costs per foot or overall OPEX. Are the gains sticking? And finally, just track the cash flow allocation. How do they actually balance those 3 priorities? Land, buybacks, debt in the coming quarters. That shows where their real focus lies.
Okay, great signals to watch. Now let's shift gears to our favorite segment. The This Is Not Financial Advice segment.
Yeah.
Where we throw out a wild, maybe plausible trade idea based on what we've heard. Remember, folks, do your own research. This is purely for informational fun.
Okay, disclaimer noted. What's the outrageous idea this time?
All right, so you take Matador's own argument that its midstream assets are undervalued in the current stock price.
Okay.
And you combine that with her disciplined brick-by-brick upstream strategy and proven operational efficiency.
Following you so far.
The potential play. A long-term pair trade. You go long Matador Resources, MTDR.
Betting on that midstream value unlock and their efficiency.
Exactly. And simultaneously, you go short a basket of smaller, maybe less efficient, pure play E&P companies, the ones without integrated midstream assets, maybe with weaker balance sheets or less obvious efficiency gains.
So betting on the integrated, efficient player to outperform the smaller, potentially more exposed ones.
That's the rationale. You're trying to capture Matador's potential upside from either a midstream deal or just market recognition of his model, while hedging some general E&P sector risk by shorting potentially weaker competitors.
It leverages their specific strengths, the integration, the efficiency, especially if we stay in a sort of lower for longer or just volatile commodity price world. In that world, flow assurance and low costs become even more critical.
It's a bet on quality and integration winning out. Strong getting stronger, maybe. Again, not financial advice.
Definitely not. Just a thought experiment.
Okay, let's wrap this up. To recap, Matador Resources reported what sounds like a really solid Q2 2025.
Yeah, strong operations, good efficiency gains driving costs down, that midstream piece performing really well, solid financials, and a clear plan for using their cash.
They seem to be managing growth, debt, and shareholder returns pretty actively, all while dealing with, the usual macro uncertainty.
A balanced approach, it seems.
All right. And one last time, please remember, everything we've discussed here today is purely for informational purposes. It is absolutely not financial advice.
Always do your own homework. Consult with a qualified professional before making any investment decisions. Seriously.
So what stood out most to you about Matador's call? Was it the midstream story, the efficiency metrics? Let us know your thoughts. We appreciate you joining us for this deep dive.